But now to get some insights on the news shaping these overall markets, for that we'd like to welcome in Tim Nyland, CFA and Co-Chief Investment Officer at Synergy Asset Management. Tim, thank you so much for joining the show to help us kick off this trading session. Now, you've argued that an Iran ceasefire could be a powerful catalyst for some of these risk assets, and I think the markets definitely agree with you. But what specific signals would tell you that diplomacy is starting to translate into lower prices and a more sustained equity rally?
Yeah, I think that we need confirmation from earnings season really to get what we're looking for here. So we're expected to deliver 13% year over year EPS growth in Q1. That would mark the sixth consecutive quarter of double digit earnings expansion. So with that, if we start seeing a lot of downward revisions, margin pressures and such, it might then confirm the bear case. But obviously any sign that we've got GDP growth and earnings remain, resilient would further back that ongoing bull cycle.
Okay, and so on the flip side, if oil stays, at these elevated levels, and if we see inflation still continue to accelerate, how do you see the Fed navigating the risk of stagflation versus recessions? And really, what does this mean right now for the overall market as investors look out for the next, say, 6 to 12 months?
Yeah, the Fed's really going to have to walk a fine line, right, between the risk of stagflation. You saw the ISM numbers come in on the services side just recently, yesterday. We've had, employment go soft. It was in contraction, the employment numbers versus the cost numbers for services, exploding above 70. So the Fed's got their work cut out for them, and they've really got to walk that fine line between, managing stagflation risks versus the recession. The Fed has signaled that they're going to be there for support to the extent the economy begins to slow. They're going to be there to help support the economy. So they've got their work cut out for them, but they need to see really what the next 24 hours, the next week or two is going to bring to get more clarity.
So S&P 500 earnings, we are tracking roughly, say, 13% year over year for growth, their pace of growth now in the first quarter, marking what would be a sixth straight quarter of double-digit expansion. But as far as right now, some of the risks to that earnings outlook, what are you seeing?
So it's really going to be around the corporate guidance. It's going to be around fuel costs. Obviously the energy costs, they're going to translate, throughout the, every industry. Everybody's going to be impacted. We have a risk on, risk off framework that we manage here at Synergy Asset Management. And that current model is reflecting, expansion in terms of economic conditions. So that backdrop still remains favorable for us. Obviously alongside the current bearish market sentiment that we currently have. So that's kind of, where we stand right now on the markets.
Okay, and within some of these tactical strategies, you are trimming some of your equity exposure, leaning into more, say, energy and short duration fixed income, keeping with some of this elevated cash. But what would you need to change? What would overall need to change for you to, say, redeploy that cash into more aggressively now into equities?
Yeah, we would need to see more signs of a firm, ceasefire commitment really from both sides. I think we stand ready to support a ceasefire agreement. I think that both sides just need to come to the table and agree on terms that we can actually put into motion. Once we see that, I think we can change our stance and redeploy.
Okay, and so you've been very clear about the fact that this is more of a correction within an ongoing bull market, not really the start of a bear market, which I do love that take. But what would convince you that the market is right now facing something a bit more structural rather than cyclical?
Yeah, from a structural perspective, if this the Strait of Hormuz remains, closed for too much longer, it could certainly start to have a structural impact. We're already facing, one of the largest oil supply shocks in history. And, now we've got petrochemical plants on fire. And, if this goes on too much further, it could definitely shift into a structural issue for us. So this is something that we're monitoring on a daily basis with our macro factors, as well as our market factors that we're looking at.
Okay, and as we know, the overall expectations for now go a bit more short term is like guidance and the overall first quarter earnings season, which are both, of course, coming to us in the next few weeks. But what specifically are you now looking for in terms of guidance that could confirm some further margin pressure versus, say, reinforce earnings resiliency?
So we're looking at the state of the consumer, right? We're looking at what's driving the margin compression, right? Is it going to be the increase in cost? Is it going to be a drop on, in demand in terms of revenue growth? And, what's really driving those downward revisions? And that's really going to, again, reinforce the resilience of the current market cycle. And then we'll obviously adjust our positions accordingly.
Okay, and your investment committee currently likes the names of like Microsoft, NVIDIA, and so at these current levels, of course, what common though themes or risk and reward profile ties do those really names have together that does make you say, hey, they're a bit more favorable in this current market environment?
Yeah, Jenny, it's actually a really good question. I mean, obviously, both of those names are currently trading below their 200-day moving averages, but even beyond just the technicals, if you look at the valuations themselves, you look at a Microsoft. If you look at its forward PE ratio relative to the S&P 500, and that's currently trading at like -2 standard deviations from its norms. So it's indicating from a valuation perspective that it's significantly undervalued, or you could say oversold at these levels. Now, obviously, they're very well tied to OpenAI. OpenAI has been struggling a little bit relative to some of these other LLMs out there. But we believe that Microsoft has a footprint into every organization and every advisor / asset manager desktop. It really for in the U.S. and probably in the world for that matter. So as far as a trusted application and some of the things they've got going on with Microsoft Copilot, being able to bring in a Claude, let's say, for your default LLM, really gives them an advantage. So they are kind of the the go-to for already being on the desktop, already being validated, from a compliance perspective. So we really like Microsoft at these levels. And in terms of NVIDIA, again, trading below its 200-day moving average. Also from a valuation perspective, that same 10-year relative PE on a forward earnings basis trading at about -1 standard deviation, so significantly undervalued.
Okay, and I love that take, and I love to hear a more positive spin on, I know there's been all this doom and gloom around Microsoft and NVIDIA lately, so I like to end it on a bullish note. So appreciate your time helping us kick off our show today. Tim Nyland, CFA and Co-Chief Investment Officer at Synergy Asset Management.